Let's hit the ground running. Welcome to this Market Intelligence Explainer for the week of August 9th to the 15th, 2026. We are tracking an absolutely fascinating week where public market friction is crashing right into extremely targeted private investment. So let's dive right in. $4.1 billion. That's the amount of disclosed capital deployed just this past week across 4 primary transactions and 3 special situations. And if you're looking for the big pattern here, it's pretty clear. High-performing specialty assets are returning to private ownership, while the big incumbents, they're aggressively stepping up to buy prevention-led underwriting infrastructure. Basically, the market is completely shifting from just renting capabilities to wanting to own the whole shebang outright. First up, we're looking at Accelerant's massive $4 billion-plus take-private deal. Get this. Thoma Bravo, the massive software-focused investment firm, is scooping up the specialty insurance risk exchange, Accelerant, in an all-cash deal. This takes one of our very few pure-play InsurTech comparables completely off the public market. But look at the glaring disconnect here between their operating reality and the public market's perception. I mean, in the year after their IPO, Accelerant's net income literally sextupled, shooting from $13.1 million all the way up to $80 million. Their exchange-written premium, up 23% to $1.32 billion. The business is absolutely firing on all cylinders, and yet, Thoma Bravo's offer of $20.25 a share, which, is a 49% premium to the previous day's close, still lands below Accelerant's $21 IPO price from back in July 2025. It just proves a hard truth. The public markets are fundamentally struggling to accurately price capital-intensive specialty insurance right now. They just can't stomach the volatility, and that's creating an incredible arbitrage opportunity for private capital. But here's what's really fascinating, the ownership structure. Altamont Capital Partners, who hold about 82% of the voting rights, agreed to the deal, but they're retaining equity right alongside Thoma Bravo and the founders. Think about what that actually means. The majority holder is looking at this and choosing continued exposure over a clean, easy cash out. They know the intrinsic value is there. It signals massive confidence in what this platform can do once it's finally freed from that relentless 90-day pressure cooker of public market reporting. They are perfectly happy to sit back and wait out the regulatory reviews, even if it pushes the close deep into 2027. Moving right along to number 2, Amynta's strategic move to acquire agribusiness judgment. So, Amynta Group, who already manages over $4 billion in premium, is expanding its specialty casualty platform by acquiring Southern States Underwriters and SSC Insurance Agency. But you have to understand, they didn't just buy a book of premium this week. No, they bought 73 years of incredibly specialized agribusiness judgment. This space is tricky. Standard commercial markets systematically underprice or just flat-out decline exposures like equipment breakdown, cargo in transit, or liability for agricultural inputs spread out over rural areas. You can't just hire a few underwriters, start cold, and expect to replicate 7 decades of risk selection. It's impossible. So this fits perfectly into Amynta's very deliberate 2026 strategy: acquire deep, niche underwriting capability instead of trying to build it from scratch. And actually scratch that, it's more than just experience. It's a structural advantage. Southern States Underwriters isn't just some standard MGA. They act as the attorney-in-fact and the exclusive distribution partner for the Southern States Insurance Exchange, which is a reciprocal insurer. By grabbing this exclusive distribution role, Amynta is securing a dedicated demand engine that's been wired directly into agricultural supply chains for decades. They are buying deeply entrenched relationships and a specific capital structure that forms a massive, highly defensible moat against anyone else trying to crack into the ag space. All right, number 3 on our list, Axle's new insurance verification clearinghouse. So Axle, a New York-based clearinghouse for insurance verification, just closed a $17.5 million Series A. Adeyemi Ayao from Base 10 Partners hit the nail on the head when he noted that everything the economy runs on, credit, payments, identity, has a clearinghouse right in the middle, but insurance never has. Well, Axle is building it, and their velocity metrics totally explain this funding round. Just in the past 6 months, they've tripled their automated workflows. They're now clearing over $100 billion, that's with a B, in coverage annually for heavy hitters like Rocket Mortgage, Avis, and Experian. Because of that crazy rapid adoption, they managed to raise roughly 4 times their prior total funding in this one single round. How'd they get that multiple? Because they solved the absolute hardest part first: carrier integration. They normalized all that messy, fragmented carrier data into a single API before they ever tried scaling their capital intensity. Now they've got the cash to rapidly expand from 5 insurance segments to over 50, effectively becoming the central nervous system for insurance verification. Number 4, FM is taking total ownership of wildfire prevention.
FM, the nearly 200-year-old commercial property giant that insures about a quarter of the Fortune 500, just acquired a San Mateo-based wildfire intelligence provider called Fortress Fire. And this completely rewrites the underwriting math. For the longest time, the industry standard was basically just broad zip code level risk exclusion, just a binary yes or no based on where a property is located on a map. But Fortress Fire uses individual structure-level physics combined with AI modeling. They take that binary exclusion and turn it into an insurable property-by-property engineering problem. Think about the so what here. Wildfires and severe storms drove 83% of the $107 billion in global insured catastrophe losses last year. 83%. The lost cost case for FM to own this tech is absolutely airtight. Now, instead of just waiting around to write a check, their 2,000 in-house engineers can tell a client exactly what's going to burn and precisely how to prevent it. It's a total game changer, moving the industry from reactive indemnification to proactive loss prevention.
And finally, number 5, a special situation over in Germany where Adesso is integrating Omnius. German IT services provider Adesso has scooped up the Berlin-based AI claims startup Omnius, folding it directly into their core insurance platform. This is the perfect example of why you embed critical tech instead of just renting it. Just look at these auditable performance metrics. Omnius processes over 1 million claims a year. By baking this tech directly into Adesso's Insure Ecosphere platform, which is already powering over 50 insurer customers, Adesso is delivering a proven 35% efficiency gain and a full 4 percentage point improvement in claims ratios. It proves that you don't just leave AI floating out there as a separate, clunky point solution that insurers have to wrestle with. You bake it right into the platform they're already using every single day, making the adoption curve virtually invisible. So, stepping back, what does this all mean for us? We've seen incredibly targeted movement this week. Incumbents are paying top dollar for control, buying up specialized judgment like Amynta did, and embedding technology directly into their stacks like FM and Adesso. Meanwhile, public markets are running scared from specialty volatility, forcing high performers like Accelerant to go private just to realize their actual value. But as platforms like Axel build these hyper-efficient clearinghouses between insurers and the broader economy, a massive strategic question pops up. Does this infrastructure layer just create operational efficiency, or does an intermediary data layer eventually commoditize the direct carrier-to-customer relationship? It's a critical dilemma every single carrier needs to be chewing on right now, as these data platforms aggressively expand their reach. The capital is precise this week. Nobody is just throwing money at growth for the sake of growth. They're buying exact structural advantages, highly specific risk selection judgment, and hardened infrastructure. Thank you so much for joining me for this explainer. I really hope this briefing helps you rethink your own market positioning. As you navigate these rapid shifts, I want to leave you with this one thought. Is your organization actively building a structural advantage, or are you just buying time against the inevitable? See you next time.